All right.
Thank you, everyone, for coming. I have a special guest today. Her name is Zelma Singleton, and she is from NRL Mortgage. So she is working with a client of mine right now, and we just got a pre-approval. And she has some great information to tell local Houston realtors. So I thought she would come to our event and share that with you guys. So if you don't already have a partnership with a lender, she would be a good person to put on your team. Of course, when we give clients a recommendation, we should give them at least three. We don't want to just be biased and give them one in case that doesn't work out, but we want to let them choose the one that works best with them. So they should call all three of them, talk to them, kind of interview them, see what works for them. But Zelma could be one of your people. So go ahead and take over, Zelma.
All right. Thank you, Vanda. So I'm Zelma Singleton. I'm one of your local mortgage loan officers. My office is located here in League City. So a lot of the business we do is Beltway South, pretty much. But of course, my goal for this year is to expand my area. And so I'm looking forward to talking to you guys, clients, if you need me, and trying to get us some deals on the table. Just kind of a little bit about myself. Houston native, born and raised, went to school here, and then I went to college in Louisiana. So I have a little bit of culturally, my culture is Houston and then Louisiana based. So I know all about that good stuff. So graduated from University of Louisiana Lafayette. I do the mortgage lending full time. I'm also a real estate investor by hobby, shall I say. And hopefully that'll be my full-time job at some point, right? So have my hands in a few different parts of the real estate business. So hopefully I'll be a good resource to you guys since we've all been introduced. So today, I'm gonna just kind of go over the loan process just to kind of familiarize you guys with, the process and how it goes. Um, I know a lot of times new realtors will, we don't know a lot about what happens. So, um, and your customers, your clients ask you questions, and sometimes we don't know how to answer them. So the goal today is just to kind of get you ready for those questions that clients may throw your way. I apologize about the background noise. It looks like we have some lawn maintenance going on here. So just to show of hands real quick, I had a question. Has anybody I know everybody's fairly new, so has anyone actually been through the mortgage process, meaning closed the loan already or done it personally? Yes, we have a few people. Vanda, anyone else? Any of our mentees? No? Okay. So this
Laura,
is
Laura,
fun.
I think Laura and Tony have.
Laura and Tony have? I don't see any. Yeah. Okay. So we have two people. Okay. Good stuff. So make sure you, since we only have two people that actually went through the process, please make sure you're throwing out your question. I know I don't think this has a raise hand feature, but just either put it in the chat. Vanda, if you don't mind monitoring the chat for me and throwing out those questions that people may have, or feel free to unmute yourself and interrupt me if you need to. Okay. I'm going to share my screen. And get it to the beginning. Okay. Can you just give me like a okay in the chat or something if you see this and we're good to go?
No, we don't see it yet.
Don't see anything?
Nope.
Let me try something else.
Tony says she bought her house 15 years ago.
Oh, awesome. So
Time for a knowledge refresher.
great.
Because we do know things change in the industry.
Oh, screen one. I think I got it.
Because of COVID, we know things are changing rapidly too.
Right.
Okay, we see it now.
Perfect. Can you still see me or no? Okay. Okay, great. Okay, so the mortgage loan process can be broken down into about 9 steps. And those are the steps that I'm going to kind of overview today. And I will explain each step in more detail as we go on. That way you will have an opportunity to support your buyers when necessary. First step, the application. Second step is the credit report. Documentation is step 3. Sign forms is step 4. Processing and disclosures. Appraisal ordered, underwriting, and then the closing. So as you could kind of see, like steps 1, 2, and 3, the application, credit report, and documentation needed, those 3 kind of happen simultaneously. And those things, those 3 steps are the things that you will need and your buyer will need to get completed before they will be issued a pre-approval. So like for me, I issue out organic pre-approvals, which means that I have ran their credit. I have had a conversation with the client. I have received all of their documentation. For me, you'll never see me giving out a pre-approval letter before then. So a lot of times you'll get a realtor that'll call you and say, hey, I talked to this lady. She's a doctor. You know, she has the down payment. Can you issue me out a pre-approval so we could go and take a look at this house? And she really, really wants it. And she wants to make an offer that day. Well, that sounds all good and fine, but believe it or not, there is doctors that yes, they may have the liquid and the money, but their credit might not be great because they're so used to working on like a cash basis, right? So in order to get the pre-approval letter, so, and I know most realtors will not make an offer on a house without a pre-approval letter. So you want to make that like your best practice, and I'm sure Vanda has already went over that with you guys, making sure that that person is a qualified buyer before you're showing them houses and offering a pre-approval, making an offer on a house on that. So let's go ahead and kind of get into the steps. So the application process is just basically various information that needs to be completed by your client. Most lenders will have a website that the client can do their application on, complete their application. Or if your client is not tech savvy, then we could always do it by phone. So you could either provide your client with the lender's information, or you could provide them with the link so they could complete it at their own convenience. Once all of the basic information is gathered from your client, then we move on into actually starting the pre-approval process. So some of the things that is going to be required in the application is personal information. So 2-year residential history. So if they only been living at that apartment or that house for 1 year, we'll need 2 years back. a 3-year work history, their, of course, how much money they make, how much, how long they have been in that, at that particular company, and their role. Income documentation. We'll need W-2s for the last 2 years. If they're self-employed, then we'll need like profit and loss statement. If they are, say, a retired person and they only, their sources of income is Social Security or their pension, we'll need documentation of that. If they receive any type of public assistance, believe it or not, that can be used as income. Child support as well. Child support is kind of tricky. If their kid is 17, then you can't use child support as income. They're, we have to have, well, for first of all, proof that they have been receiving it. You can't just have an order, because we all know that sometimes ladies or gentlemen do not receive the actual child support that they should. So we have to show a history that they have received it, and also a future projection that they will receive it for another 3 years. And then also alimony as well can be used as income.
I have a question, Zelma. What about um, housing vouchers?
Can that be used as income?
Like I heard people can get them if they're getting Section 8. They can actually buy a house with a housing voucher. Does your company work with those?
That's a new one for me. The only thing I could see that being is like as income for them. Meaning, because if, say, your rent is $1,200 a month and housing pays 1,000, then that means you're only responsible for the $200 or whatever. I could see possibly that being used. I would have to do some research on that one, because I've never heard of that one. Public assistance, yes, like if they receive like TANF, or like people get money on cards, but I've never heard of the housing voucher. But I definitely looked that up.
Learn something new every day.
Yeah, that's new to me. But hey, if they have the a job and a credit, the housing voucher, you know, we shouldn't be a problem. Okay, so this is going on the LE. Once we receive all the documentation for your client, all of their personal information, this will usually be when I issue out a pre-approval letter. Most times I'll send it to you, and send it to you, the client as well. Sometimes I don't necessarily like to send it to the client, because if you refer a person to me, I don't want to send them the letter and then they end up taking it to another realtor. So I try to be very smart about that, because I want to respect your time as well, and our relationship. So usually I'll send it directly to you unless the client specifically asks for it. Then I do have to provide it to them. Then the client goes out and shop and everything. You guys find a house, you make an offer, and then what's the next thing is we call it a LE. It's a loan estimate. Sometimes clients ask for a loan estimate ahead of time, but typically I don't send out a loan estimate until they actually found a house, because the numbers could be so can vary so much. So on the loan estimates, it'll have rates, a proposed monthly payment, and it'll have taxes, insurance, and things like that. But until they actually have a house, I don't know what taxes will be, because it could be a wide range, right? Usually I'll shoot for 3%, because that's typically what it is in this area. But we all know in some areas taxes are higher. They have mud tax, they have this, and you'll kind of learn that as you go. So Ellie always have rough numbers. And I always want to give worst case scenario. That way, once the numbers go down, it will keep our clients satisfied and happy. Instead of going up, we always want to go down. Any questions so far? Can someone unmute themselves and just tell me what is step 2?
I
Wale?
actually have a question.
Okay. I'm gonna get to you in a sec, Wale. Let me take this question.
It's actually in regards to commercial lending. So, is the process similar in commercial lending?
Far as I know, yes, but I don't have any experience that with commercial lending, but I believe the process is very similar. Are you gonna be commercial realtor? Are you a commercial?
Um, I actually have a client now that's I'm actually en route to meet with, and they're open to leasing and buying as well. So I was really interested in the commercial side of lending so that I could present that offer to my client.
Right. I particularly am not licensed to do commercial lending, but if you need a referral, I do have contacts because, of course, I run across people. I'm sure Vanda has contacts as well for commercial lending, but personally, I've been like involved in some commercial lending transactions, but I have never gotten to the closing table. But I mean, as you know, yes, it's very similar, but I'm sure there's other details that are involved. Thanks for your question. Wale?
Thank you.
I'm breaking up here.
Hello?
Yes, sir.
No, so I want to know what's the typical credit score?
Ooh. I mean, the average person is within like high 600.
Okay.
We find that the sweet spot is like 640 or above. That's a great question. So that kind of brings me into something else. Different lenders have different criteria. Right now, criteria is a little bit more stricter because of COVID. So in the past, we were able to do, you know, clients with 580, 600, but it has gotten a little bit more stricter because of COVID. So you'll have lenders that work with, for me personally, it's usually about 640. That's the sweet spot. I could do below 640, but then they ask for like crazy stuff. So for example, a client can have below a 640, but their DTI needs to be below 30, or they need to have about 6 months in reserve. And those typical situations don't really just happen together. If a person has a low credit score, most of the time they don't just have a lot of cash saved up. I mean, unless something, has happened where they have been put into that situation. So it's workable, but that's just not, those are always kind of exceptions. Most people, if they have a low score, they don't have a lot of cash, because if so, they probably wouldn't have a low score. Like the example I gave earlier about the doctor, that's an exception, because a person, she has a low score, or they may have a low score, but it's just because it's not that they're not paying their bills on time or anything like that. They're just used to working in like a cash world.
Okay.
Thanks for that.
What's
Anybody else have a question? Go ahead.
I guess I want to know what's the highest score that you've seen denied, and what's the lowest score you've seen approved?
High scores don't really get denied.
No, but I mean, the highest, not necessarily that it was high, but it still got denied. Let's say a 600 could get denied, right?
Yes.
Exactly.
And
620.
I mean, you have you could have a 702 and get denied, because when we pull credit, it is not just looking at your score, it's also looking at your debt and how much money you have when to monthly. So that's one of the things we talk about is the DTI, which is your debt to income ratio. So your credit score may be 700 and something, right? Great, but
You got a lot of bills.
you have a lot of bills, so that will also play a factor in being denied.
Okay.
Okay. All righty, guys, ready to move on? All right. So the purpose of the credit report is, of course, to obtain their credit and if they are eligible to apply for a mortgage. One of the practices you want to like be prepared for and start putting in your little toolbox is having your clients monitor their credit. Also, possibly getting a copy of their credit report before you send them over to a lender. And I know that, that it's a great idea and it would happen in a perfect world, but not every time you would be able to do that. Most people don't do that, but it would be a best practice. And the reason why I say it would be a best practice is because credit reports cost. It costs to pull a credit report. You even get some lenders that are asked for the client to pay for it ahead of time. If you go with like some big companies, they won't. But like if you work with a really small lender, they'll ask the client to pay for their own credit report. At my location, we don't ask the client to pay the credit report, but it costs us like $50 like per couple. So if it's like 30 some dollars for an individual, but if it's like a husband and wife, it costs about 50 something bucks, about $55 or so. So, if we know that the person is in need of credit repair, one of the best things to do is just send that person to credit repair before you send them to a lender, because you don't want to waste have some unneeded expenses and wasting time doing that. So when we pull the credit, some of the things we're looking at, and this is kind of bringing up to Wale's point, we're looking at the credit, the FICO score, we're looking at monthly debt commitments and their credit history. So FICO score, includes a lot of different things. You have a lot of clients that'll come to you and say, oh, well, Credit Karma say I have a 740. And when I pull it, they have a 653 or they have a under 620, right? Being aware and educating your clients that Credit Karma is good for educational purposes, but when a mortgage company pulls their credit, it's a hard pull and it is going to be very factual. It's not anything that you would see on Credit Karma or Credit Sesame or anything like that. So those scores give you a good idea of what the score may be, but you always want to just kind of have in mind that it's probably not going to be that high. And sometimes it happens. So power to some, but most of the time it's kind of like not really realistic. So making sure you are aware of that and educating your clients on that as well. Them questions?
Yes. What does hard pull mean? I always hear that term, but I don't really know what it means.
Okay. So, they're in the credit world. Let me see how the best way to describe that. There's a certain thing as a soft pull and a hard pull. So a soft pull is just like when they kind of just take a peek and just see what your score is and what it may be on all three bureaus. A hard pull actually affects your credit, which means when they pull their credit report, they will see Nations Reliable Lending has pulled their credit. And when you think about it, people will say, well, is a mortgage a hard pull? Well, think about it. This is a 30-year loan. Yes, it's going to be a hard pull because these people are considering lending you hundreds of thousands of dollars for 30 years. So yes, it's going to be a hard pull. Now, what if your client comes to you and says, well, I really don't know what my credit is, whatever. I can do a soft pull on the credit where I could just peek and see what it is. And then if it's good enough, I'll do a hard pull. However, guess what? A soft pull costs money and then a hard pull costs money. So if I have to do that, so I would only do that for like a serious buyer that I'm like thinking that this person is really ready to buy. So when I say that, you know, you could put it out there for buyers that you think may be a good fit for that, but you don't want to just throw that out there for everyone because again, you know, the expenses start rising up, you know, unnecessarily. If you know, if the person says, I know my credit is messed up, that person will be a good candidate for credit repair. So that's another tool. Get you a credit repair person that you know is effective and that you could recommend to your refer to your clients. I have a credit person that I refer my clients to. Always good to have that person in your pocket because if that person is not ready to buy or not a qualified buyer right now, um, they may be in a year or two if you know they get to that credit repair person and work with that person, takes all the necessary steps. It also will tell you if that person is really serious about buying because people with low FICO scores and bad credit, shall we say, they may have had extenuating circumstances in their life to cause that and they're ready to make changes. And so if they start taking the steps to make those changes, then you know, okay, this person is serious about buying. But if a person just comes to you and they have a 580, they know their score is bad, and they're just like, well, either give me a house or not, then that's not typically a buyer that you want to really pursue because they're not taking it seriously. So just kind of reiterate, soft pull doesn't necessarily affect your score. It just kind of gives a peak of the score, but then a hard pull, it does affect the score, which means if they do too many hard pulls within like a year's time or so, then yes, it actually lowers their score. All right. So this is where it says to help the buyers with your credit problems. And that's kind of, I've already kind of touched with that. Again, people have reasons why they may have, or it just may, a lot of times in certain communities, it's a lack of knowledge. We just, you know, it's just passed down from generation to generation. So try your best to educate your clients on how to help them with their score. And it's only so far that we could go. So then that's where your credit repair people will come in. And there's a million, so to elaborate on that, there's a million credit repair people. Find someone that you know that has actually had results and effective. All right, some of the things that you could recommend to help your buyers pay their bills on time, keep the credit balances low. This one right here is a big stickler. I see it all the time. We call that credit utilization, which means if like that you have a credit card, it's $1,000 credit limit. Well, the balance on there, they have charged up $9.99, right? So that means there's only $1 available left. Well, again, when I say lack of knowledge, when they give you 1,000 credit limit, you're really not supposed to go over $300, 30%. So in my younger days, I'm like, sure, that's money I'm leaving on the table. But guess what? You are dragging your score down every time you do that. Yes, it is money out there, but when they give it to you, they extend it to you. Of course, you could use it if you need, but believe that it's hurting your credit. So educating your clients to keep their credit utilization below 30%.
I have another question.
Yes.
Does a high student loan balance affect getting a mortgage?
Yes It does. And no, it's not the balance of the student loans per se, it's the monthly payment that really affects them. Because remember, I'm looking at DTI, how much of your paycheck goes to your bills. So if you have $100,000 in student loans, but you only pay $100 a month, that's all I have to count, $100 a month. But if you pay 1,000 a month, I have to count 1,000 a month against you. Then in these days and time, we have a lot of people that are on zero, or they're still in deferred, or it just automatically deferred because of COVID. If that's the case, fine. But when they come to get a home, we cannot use a zero payment. So unless your client provides documentation of the actual payment that they make, I either have, worst case scenario, I have to use 5% of the loan balance as their monthly payment. So what I always recommend to clients, and what you can do as well, if they know they're on deferred, they need to get some type of payment plan set up, income driven payment plan or whatever, because a lot of times if 5% may be $500 a month, but nobody's really paying $500 a month for student loans unless they make a lot of money. So I need the documentation to prove what actually their payment would be. I cannot use the zero balance. All righty. Oh, so keep the balances low, limit the credit accounts to what they need. So, you know, you'll see people's credit and they have an account at every store in the mall. And that's probably not a good idea, just because even though they don't have any balance with them, it could still count against you depending on the type of account it is, even if it's like $25. And sometimes $25 may be the threshold that's throwing you over to not get approved for a mortgage. So educating your clients, don't have their credit ran unnecessarily. So when you go to check out and they say, do you want to apply for a card? And you're like, yeah, you probably shouldn't do that. Check their credit report information for accuracy, making sure everything is correct on there. And then, of course, I just touched on that. Be conservative when applying for credit. Only apply for, what you need. So some of the documentation that the borrower will need to provide in order to get their pre-approval and get to the closing table is going to be the 2 years of tax income, the most recent 2 years W-2, and I kind of touched on this. Last 30 days of pay stubs, 2 months bank statements, and copy of ID and Social Security. So those are the main documents that we ask at the very beginning before we even issue out a pre-approval. The following forms are forms that we'll need to sign as well. Usually in our office, we call these wet forms. These forms have to be printed out by the borrower, signed with a pen, and then sent back to us. These forms are not accepted with like DocuSign and things like that. And so the first one is the IRS form 4506T. That's just to validate their tax returns and that they're not fraud, I guess. Social Security authorization, that they are who they say they are, because they send us a copy of their Social Security card, but so this is the validation of that card. The borrower's authorization form, we call this a VOE. Sometimes you'll hear it being called that. It's a verification of employment. So they basically give us permission to call their job and get all of their information saying that they worked there, how long they worked there, how much money they made. A lot of times you'll get individuals with like bonuses. Well, we have to verify the bonus with the employer as well. So you'll hear this being called a VOE, short for verification of employment. And then undisclosed debt acknowledgement is the last one. And then that's just any credit that they may have that's not showing up on their credit report. It's given authorization for access for that information as well. So after I receive everything, it looks good, and your client finds a house, you guys make an offer, the offer is accepted, everything is gathered and presented to a processor. A processor may ask for additional documents. So I always like to say, like, me and the processor, or like a attorney in a court case, right? And then we get everything together and we submit it to the judge. Well, the judge is called an underwriter, and the underwriter is the person who makes the final decision. At my office, our underwriters are in-house. They actually work for our office. And so, but every lender is not like that. And so once you start getting into transactions, you'll kind of see and notice the difference. Particularly, I like in-house underwriters, and a lot of realtors do as well, just because, I'm not having to call Susie, somewhere else and see, and like, not a contractor type of thing. It usually goes a little bit smoother if you have in-house underwriters. We're not sending it off to somebody and letting them look at it. Everything is done right here with us through our company. Once it's submitted to the underwriter, so the processor gets everything, they make contact with the client, they may ask for more documents. So for example, I may have issued out a pre-approval in January. Your client does not find a home and get an offer accepted until March or April, right? Well, at this point, the 30 days of check stubs they sent me is old. Their bank statements they sent me, that's old. So when everything is presented to a processor, the processor may request those documents, updated documents from the client as well. They may have asked some information about their credit report, going into more detail. So it's like me, then the processor, and then the processor sends everything to underwriting, which again, I like to call it the judge, right? Any questions about processor? This is kind of like an important step. All right. So once the client gets a house, and we talked about the LE, well, the LE will be like the initial disclosures. Disclosures are sent out. So it's usually about 4 sets of disclosures, and disclosures just letting the client know. So like, hey, we received the formal application, we have everything, we have a house, and then this is what your potential interest rate could be. It's a difference between like a estimated interest rate and then a locked interest rate. Sometimes the mortgage loan officer will lock the interest rate right at the beginning, but interest rate is only good for, well, locked interest rate is only good for about 30 days. So by the time we get it to underwriting and everything, it takes about 30 days. So I typically don't lock till about 15 days before closing, just because I don't want it to run out. If we do have to extend the lock, then it's an extra charge for the client, and so on and so forth. And we don't want to do that if necessary. So sometimes we'll lock pretty early if we see like the market is gonna go crazy and the interest rate is gonna go up. But typically, I know a lot of times people don't understand when they say interest rates. Interest rates change every day based on the stock market. So I may say it's 2.99 one day, but then the next day I look, it's 3.125, or it could be 2.5 the next day. So it really just depends. So it's best practice to quote a higher interest rate. That way, if it goes down, everybody stays happy. But if you quote a low interest rate and it goes up, everybody gets upset. So typically in your role, you want to shy away from quoting interest rates anyway, because you don't want to, under deliver, and, like we say in the business, stay in our lane, right? So disclosures go out. And then once the disclosures go out, the client has to sign on the e-disclosure. You know, they could sign those with the e-disclosure. Then we will go into the lock eventually. During this period of time, usually we're waiting on the client to get documents in. So again, stress. Get the documents to the loan officer, to your client, because they'll see an email from us. They'll go to Laura and say, Laura, can you send me, come show me, I seen these 5 houses that I like, Laura, and Laura's out there showing her 5 houses and wasting her precious time. And then when she send me the documents, she makes $1,000 less than she told me over the phone, or that $1,000 she had was with her commission, and I can't use commission because she only got commission one time this year. So that's another thing with clients that get paid commission and bonuses and things like that. I'm a former teacher. I forgot to mention that at the beginning. I taught middle school for 10 years. Well, they gave us bonuses as well for like attendance and things like that, testing, so on and so forth. Well, unless your client has a 2-year history of those bonuses, you can't use that bonus. So in a teacher's world, I could only use that person's base salary unless they got that bonus for the last 2 years, then I could use that. So please, when clients call you, hey, did you send your documents to the loan officers? If they say no, then they're not serious about buying. So again, the loan estimate, this is what we call the LE. It has estimated cost of taxes, insurance. Typically, I will get an insurance quote or two, and then forward it over to the client and let them choose, or they could choose their own. But I just like to get a quote so I could put a real type of number in the estimate. But again, the interest rate and the payments may change. So I always try to shoot high. So then that way, when it goes lower, if it goes lower, we're in the best case scenario. The loan estimate will also cover any penalties for paying off the loan early. Typically, these loans are not best case scenario for the client, so we usually don't offer these. But if we have a special client that wants to, then of course we have those products available. And in the increases in the mortgage balances. The appraisal. So after, if your client elects to do inspections on the house they're under contract for, then we will order the appraisal once they're approved. So like I'll give an example. The other day we have a client under contract, they've done inspections, they came back, the house needed a roof. So then they said, okay, we don't want to move on with this house. This is more than we wanted to deal with. So I don't order appraisal until inspections come back, because appraisal is paid up front. And so if a client has already paid for appraisal, now that client is out of the inspection fee because they wanted to know if this was a good house or not. And then they're out of the appraisal fee as well. And we don't even need the appraisal. Then we have to deal with refunds and all of this good stuff. So inspection, so contract, inspections, then appraisal. Now, when we talking about appraisals, the home has to make value. So if you are under contract for 265,000, after the appraisal comes back, the house is only worth 260. You have to, as a realtor, go back to the negotiating table with your client. Let me not say that. A client can pay however, they could pay $1 million for the house, but we cannot lend for more than the house is worth. So if that client still wants to pay, say 265, and it's only worth 260, they have to come up with the difference, because as lenders, we cannot lend on something that is not worth that value. So sometimes I know in today's market, people are getting into bidding wars and they're paying this and they're paying that. Well, make sure that if your client wants to go that route, that they have the money to make up for it. Plus their down payment and everything else. All right, and then the judge comes back, the underwriter, and gives us a final decision if we should approve the loan or not. So typically when we're in this time getting appraisals and everything, the underwriter will come back with a conditional approval. And an example of the conditional approval will be, yes, we say yes to this loan, it's approved. However, we want the client to take a first-time home owners class. And once that client takes that class, oh, and we also still need her next month's bank statement when it's released. Once the client turns in that homeowner, home buyer's education course and turns in their most recent bank statement, we're good to go. So that's an example of a conditional approval. And we don't know what the conditions will be. That's all up to the judge, the underwriter, to tell us what conditions they are looking for. I've even had a condition where a girl was buying a house with her fiance. He was giving the down payment, but he wasn't on the loan. One of the conditions was that they had to write a letter and say, you know, they were engaged and they've been dating for this long and they plan to live together and all of this. So we never know what the conditions will be. It'll go from take a home buyer's class to you and your boyfriend need to write a letter and say that y'all intend to be married at some point and that he's just not a guy on the street that gave you $30,000. Like, where that happened, I don't know. Like, who would just give somebody $30,000? Why do they have to write a letter? Obviously, they have a relationship. All right, so once the loan is approved, the final transfer and closing funds. So at that point, if it's like a wire that your client needs to do, they would start communicating with title. Everything would start going to the closing department. Again, we have our own closing department here at NRL that does everything for us in-house. And they work with title, making sure everything is clear on that piece. And they start preparing the documents for actual closing to get it to the closing table. So some of the things that you can advise your buyers on and what to expect at closing is if they have to bring any funds, that they would need to bring those in a cashier's check for down payment and closing. Those funds will be made out to the title company. Personal checks are normally not accepted. And so making sure that your client goes to the bank and physically gets that cashier's check to bring the closing. If there is an instance where, say, they made the check for $1,000, and then when you get to the closing table, it needs to be $1,200, your client can then, pay that difference. Or if it's they made the cashier's check for $1,000, but it was really $900, then title would write them a check for the difference. So we could work around that if there's variances. The client would need to review the final documents, which we call the closing disclosure, the final disclosure. And once they've signed that, that has pretty much everything hard. By this point, the client has already said, this is the insurance I'm using. We already know the taxes that they're using. We have their monthly payment. We have all the fees in there. So this is the final. They sign the loan documents and make sure at the signing that they bring their identification. It says proof of insurance as well, but typically the processor already has that and good to go. So that's not something that typically the client would need to bring, but definitely identification. All right, guys. So I'm gonna just kind of open up the floor for questions. If you guys have any questions, comments, or concerns, if y'all just want to chat, if Vanda, if you have anything you want to add, we are open.
I just have one question. We at EXP are just now starting to get into commercial. And do you have a relationship with a commercial lender that maybe we can get on here one Saturday to have him talk about his process as well?
Yeah, I could, I'll forward you his information and
Okay,
see if that's something he's interested in for sure.
okay.
Hi, this is Anisha. I have a quick question for you. Whenever we refer a client to you, how do you keep the realtors in the loop?
Oh, good question. So typically once I pull the credit, Anisha, I would update you guys, say, hey, this seems like a pretty strong file. This person's credit is good to go. We could work with it. They have low debt. They, you know, this, I'll give you a quick overview verbally, by text, email, or over the phone, and just kind of let you know where we are. So you'll know if you can go ahead with showing this person. If I say this person needs credit repair, their credit score came in too low, or their debt is way too high to get it approved, then you will know how to approach it. But typically I try to keep the realtors in the loop at every stage, whether it be by text, by phone, or email, depending on your preference too.
Are there any incentives for realtors bringing loan officers, clients?
Of course, getting your loan closed.
Okay. I mean, incentive, like I could have you and 5 other loan officers in my database. I'm like, who do I need to bring it to? Like, is there any?
No, that would be illegal.
Okay, that's why I was asking. I didn't know if it was legal, if there's incentives that you guys can give.
No, I mean, I always say it's who you mesh with well. Like I met Vanda a year ago. You know, we chatted, we got to spend some time together. I like her, she like me, and you know, you want to work with people you like.
Okay. Well, I guess one more question. What's the difference between you and 2 other loan officers that can approve somebody or that can't approve? Because I think you mentioned they should go to 2 or 3 different loan officers and see who can, you know, get them.
Right.
Like, what are you doing, or the next loan officer doing that helps out the client?
I think that the main thing you want to focus on is the person that will serve your client best. So, for example, if you send me a client and the client has a 600 credit score, well, I may not have a product that will fit that client that has a 600 credit score. So, if you have several loan officers in your pocket that you could use, okay, well, Zelma can't do anything with a 600 credit score, but I'm gonna send them over there to Michael. Michael has a product that they will accept a 600 credit score. And so working with the loan officers that has the products that are best fit. If you have Spanish speaking clients, I don't know how to speak Spanish. So you may want to go with a loan officer that can work with your clients that are bilingual. So again, it's not necessarily like somebody's doing something special that the other one is not.
Right.
I think it's more so of picking the people that, again, that you like and that are going to be the best fit for your clients.
Okay.
Hey, Zelma, this is
Yes.
Tony.
Hey,
First of all, this was amazing. Awesome. Thank you so much for doing this. I had a weird question. In one of our meetings on Tuesday, in the Texas brokers meeting, and any of you all who were like listening this week, maybe I misheard something or I misinterpreted the information, but they had a lender on who was giving a housing update, which was really, really awesome. But during part of the presentation, I thought I heard her say that a lot of lenders, they were doing more on like new loans versus refinancing, that they were more apt to do a new loan versus helping somebody refinance their current house. Is that trend true?
Well, I'm I can't verify that, but right now we're in a refi boom. So I don't know, which means when I say we're in a refi boom, it's because like somebody that bought a house 4 years ago may have purchased at a 5% interest rate and now they could get it at a 2.99. I mean, it's
Right.
refinancing. So I don't know if that's true. Excuse me. So.
Okay, yeah, I thought I was like it kind of confused me a little bit because I thought there were a lot of people refinancing, and I know there's a lot of, people out there right now that, like, one thing that I ran into a couple months ago was I met some people at an open house and they were super interested in the house, but then they decided that they were just gonna, like, they were in a love it or list it scenario, and they decided they were just gonna go, keep their current house, but they were just going to do like a ton of, renovations. And I think one of their conduit to that was, oh, well, I'll just refinance and, I can, get enough, get a bigger loan, and then I can cover my renovation values. So I was kind of just, when I heard that, I was just kind of curious because I was like, oh, so, how does that factor into somebody making a decision? Do I renovate my current house, or am I better off just, with interest rates being what they are, just try to upgrade into a brand new home and just get a whole new home loan?
Yeah, I mean, so I just bought a house in October. For me, with rates being so low, you could buy more house because you could afford more house because your rates are lower. So for
Right.
me, it was like, oh, okay, let me get a new house. In a normal world, because like I had another house that my interest rate was 7%. And then when I got the new house, and believe me, comparing the houses is like, this is a shack compared to the new house, so 7% versus buying a nicer home for a rate at 3% or below. I mean, it's a win-win. So I think it just depends on that person. But it's also people that, because moving is stressful. So yeah. I don't want to move. So it's better for me. Another product that, I mean, typically you guys wouldn't be offering that because you would be probably dealing with people that's trying to purchase a home or sell a home. But a lot of people are doing a cash out refinance, which means, like you gave an example, I'm just going to remodel my current house and make it new. And if they have been in the home long enough and they have equity in the home, they could actually take money out and do whatever they want with it. They could consolidate debt. And what's so crazy is that, like, I've had a client do a refinance, pay off their car note because the mortgage is lower than the car. So being aware and just educating your clients, like letting the money work for them. It is really cheap to get money right now, meaning, the cost to get a loan. However, that means that on the other end, you need to have some good credit. And, if you're buying a new house, you probably, you need to have all the other things that go with it. So when the interest rates were higher, they were kind of a little bit more lenient, but, so it, I guess, varies. When one thing changes, the other thing changes.
Sure.
Yeah. So I would say right now, is a little bit of both, because it's also a seller's market where Vanda and I was having a conversation the other day about seller concessions. Like right now, they getting so many offers, nobody wants to give seller concessions, So I can't say if it's true or not, but in my experience, I think we're getting a little bit of the best of both worlds at this point.
I was going to ask you about that. Can you explain seller's concessions to everybody?
Sure. So a seller's concession is when the seller actually contributes like a credit to the buyer for, buying their house. Okay, so we talked about, well, we didn't really talk, we just talked about the loan process, but your client will most likely need a down payment. Well, in addition to their down payment, they will need closing costs. Closing costs range about $6,000 to $7,000. So just say if you need $5,000 to put down, then you need another $6,000 for closing costs, then that's $11,000. So as a realtor, what you would negotiate is with the seller, can you contribute $5,000 to my client? And then that way that client would only need $6,000 at closing versus needing the full $11,000. So seller concession is something that you negotiate in the contract, that is a credit towards the buyer. So when we talked about seller's market, if I am selling my house and I have 3 offers on the table, one person is asking for $5,000 in credit and the other people are not, or whatever. I have 2 that's asking for a $5,000 credit. One that's asking for $5,000 credit. The other one asking for $6,000 credit, and the other one asking for nothing. I'm going to pick the person that is asking for nothing, depending on, the scenario. So that's a good thing to work with Ms. Vanda about, the negotiation and the arrangements of your contract and everything with that, because sometimes as a lender, you will call, I will call my realtor and say, hey, I could work with Susan. She has great credit, whatever, but she only has $5,000. So when she finds a house, she's gonna need seller concessions. And so in order to benefit Susan and yourself and myself, your job is going to be to negotiate those seller concessions or find her a house, where everything could be worked out.
I have a question about down payment assistance programs. Is that something that you would suggest to a buyer, or is that something they would need to inquire about and then get the information from you or on their own, or how does that work?
Down payment assistance are available. Right now, they need to have good credit. And so a myth about down payment assistance programs is that you don't need any money. Even though you have down payment assistance, it's possible that the client will still need money. Meaning, I like to say that they need to put some skin in the game. Like nobody is going to give you a 30-year loan and you didn't come with nothing. So it used to be like that, like a long time ago, but they don't do that anymore. So again, I just used the example of a $5,000 down payment and $6,000 closing costs, right? Well, if the client qualifies for $5,000 down payment assistance, the down payment covers $5,000, or sometimes it'll be a percentage, so it may cover $1,000 to $5,000, maybe a little bit more out of but who's going to pay the closing costs? The client still has to pay the closing costs. Now, if Ida, you are a great realtor and she gets down payment assistance and you negotiated seller concessions, it's possible that client doesn't really have to have any money for closing. But then guess what? The bank wants to see that she has enough money in her account, which what we call reserves, to pay the loan for the next 3 months. So you can't have like $100 in your checking account, need down payment assistance, and asking for seller concessions, because guess what? If push come to shove and you can't pay your mortgage, you didn't really contribute nothing, so you're going to walk away from it. And that's how the lender looks at it. So they need to have some type of skin in the game in order to ensure that they're taking this mortgage seriously and they can pay it for 30 years. Any more questions, guys?
Do you typically refer clients that aren't represented by a realtor to any realtors that have referred to you?
Yes, definitely. So I don't typically get people that come to me that aren't represented, but there's been instances where I had like family members that have come to me, and then I'll send them over to a realtor that I've worked with or things like that. Or I'll meet somebody out at a restaurant and they ask me about a realtor just because they see that I have a mortgage or something like that shirt on. And then yes, typically, but that's like far and in between. But yes, if I have realtors that I speak to often, that I work with, that is constantly sending me clients, and I happen to get someone, yes, I definitely send them your way.
You guys have any more questions for Ms. Singleton?
Thank you very much for your time for doing this, Vanda and Selma. Thank you very much for helping us learn more. I
No
appreciate it.
And then I just thought about something, Wale, when you were asking about, like, you know, how do you choose the lenders that you're going to deal with? Some of the other things is like, you know, like for me, since I sometimes go in with half with realtors on ads, like to get their name, because it's beneficial to both of us.
Okay.
So, you know, you just kind of have to think about, you know, what are your goals, find somebody that aligns with the same thing. Like if somebody has an open house, I've handled the sign-in sheet, then make all of the phone calls, because at the end of the day, if that realtor sells that house, I could get paid off of that loan as well. So finding somebody that is willing to work with you and you're willing to work with, and, you know, just going out there, putting yourself out there, and, you know, have a mutually beneficial relationship is, you know, a good way to find somebody to work with.
Okay.
That's what I would suggest. So that's it, guys. If there's no more questions for me, on the screen, I have my contact information. This is my cell, so you can text me or call me anytime on here. You can send me an email if you need to contact me. If you want me to have your contact information, send me a text or an email and say, hey, Zelma, this is such and such from the Zoom meeting, and we could stay in touch. And other than that, I thank you guys for having me. I hope this was helpful, and answered your questions. And if you need me, please reach out.
Thank you very much. It was a
Thank
pleasure meeting you. Thanks.
Thank you.
Thank you, Vanda. I hope you have a beautiful weekend to all of you.
You're
Thanks.
welcome, guys.
You guys.
Thank you.
Contact me if we need me. Nice to meet you, Ida.
Likewise. Thank you for having me.
Thanks, Anisha, for inviting her.
And this is going
You're
to be recorded, right, Vanda? You're going to send it to us anyway?
It's recorded, and I will send it out to you guys.
Okay, well, thank you very much. You all have a very blessed weekend. Okay.
You too, Laura. Bye, everybody.
Bye.
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 Thank you, Vanda.
Thanks, Zelma.
Thank you, Selma.